After work tonight, you will sit down at your trading charts. And somewhere during that session, you will cross a line you can't see. On one side, every minute makes you sharper. On the other, every minute is making you poorer. Most traders cross it within the first 30 minutes and spend the next 3 hours paying for it, convinced they are putting in the work. And it gets worse. The next time you force yourself to stay on your charts because walking away feels lazy, you are funding the exact trading habit that's been draining your account. By the end of this video, you will know the name of that line and where yours sits. The traders who spend 4 hours after work analyzing trading charts consistently make worse trading decisions than those who spend 30 minutes. They are likely more skilled. And that's exactly the problem. In the year 2000, psychologist Sheena Iyengar set out 24 different types of jams in a California grocery store. Then, 60% of shoppers shopped to taste, but only 3% bought. Then, she stocked 6 different types of jams. Fewer people stopped, but purchases jumped to 30%. 10 times more sales from fewer options. The shoppers were overwhelmed, and the options that were supposed to help them choose stopped them from choosing at all. Your trading screen, after 30 minutes, works the same way. Every extra trading setup on your screen is another jar of jam. I call that crossing point the effort flip point. It's the moment in your trading session when additional screen time stops adding information and starts adding interference. Before the flip point, you are analyzing, but after it, you are manufacturing doubt. And the reason it stays invisible is because doubt feels identical to diligence. You're telling yourself, I'm being thorough. I just need to check one more pair. But your brain crossed the threshold 20 minutes ago, and everything since then has been noise dressed up as research. The screen does not reward overtime. But knowing that the effort flip point exists does not explain what happens after you cross it, because the damage is worse than bad trading decisions. Someone is collecting on every one of them. Almost every trading course and mentor that you've encountered measures progress by how active you are. But one of the most profitable traders of the early 20th century credited his biggest gains to doing absolutely nothing. Jesse Livermore operated in the early 1900s. After years of frantic buying and selling, he arrived at something that contradicted everything the trading floors believed. His biggest profits came from positions that he placed and then left completely alone. The trades he analyzed most carefully, the ones he managed most actively, were the ones that underperformed. He watched other traders filing in and out of the exchanges every day, convinced that activity was progress. Livermore's observation was clinical. Those traders, the ones who felt they had to trade every single day, were laying the foundation for his next profit. Their activity was his liquidity, and their noise became his edge. Each one probably walked in that morning thinking, today I'll make it back. And when Livermore broke this rule, when he traded too frequently or let the noise pull him into positions he didn't need, his results collapsed. His analysis was fine. His attention corrupted the execution that his analysis had already completed. And after losing multiple fortunes, the lesson he kept returning to was always this: money is made by sitting, not by trading. Every evening session that you extend to the point where you finished your analysis, you are the trader Livermore was watching from across the floor, and he was grateful for your activity. What Livermore paid every time he broke his own rule is what I call the attention tax. It's the hidden cost of every hour that you spend watching charts beyond your initial analysis. The cost shows up as decisions that you would not have made if you had walked away. Missing one good trade a week from leaving the screen costs roughly 2R, where R represents your dollar risk per trade. But staying glued for the extra 3 hours costs most traders approximately 10 hours or more every month in revenge trades and FOMO entries that they'd never have taken if the charts were closed. The trading industry hardly talks about these tax because your screen time is someone else's revenue. Every extra hour generates spread, commissions, and data fees for the platforms and brokers who build their business around keeping your eyes on the screen. You are grinding for them, and you've been calling it dedication. You can see the attention tax now. You can probably trace it in your last session that ran too long. But the tax shows up differently depending on what triggers your overtime. Some traders bleed through revenge trades after losses, others through FOMO entries during slow markets, and a few through the constant second guessing that turns a winning trade into an early exit. The tax is the same, but the trigger is different, and that's the gap this video can close. I don't know which trigger is draining your account the fastest, but the free 3-minute quiz in the description does. It's called Why Am I Still Losing Money Trading? And it takes less time than your next bad trade will cost you. The link is in the description for you to get your diagnosis. But the attention tax only explains what your extra screen time is costing. It doesn't explain why your limited time might actually be the advantage you've been apologizing for. Most traders who cut their screen time from 4 hours to 30 minutes expect their results to get worse. But the data shows the opposite. And it's not even close. In August 2013, I started by day trading the 1-minute and 5-minute charts. It felt exciting, signals everywhere. My phone was glued to my hand and I was checking charts wherever I went. At work, at lunch, on the way home. Every morning I'd open the charts with a plan, and every evening I'd close them having ignored it. I placed 71 trades in 3 months, and I lost 92% of my account. I was left with $20, still planning my next entry. But losing money was only half of it. The whole time, I genuinely believed I was working hard because the screen time felt like effort, and effort was supposed to produce results. Nobody told me that in trading, effort past a certain point produces the opposite. I was stuck, and I couldn't see why. Then someone challenged me to try something that felt irresponsible. Check the charts once a day. The first time I tried waiting for a setup instead of hunting for one, the anxiety was almost unbearable. I'd open the daily chart, see nothing worth trading, and feel physically restless because doing nothing felt like falling behind. I was in withdrawal from the very thing that was destroying my account. And it took weeks before I stopped reaching for my phone out of habit. The hardest part was that every other area of my life rewarded more effort. My job did, my education did, but trading was punishing me for the exact habit that made me successful everywhere else. Imagine you're at your desk after a full day of work. 20% of your mental energy left. You open TradingView and the first trading candle looks like it might be forming something. So you zoom in. Just a bit more analysis. 20 minutes later, you are switching between markets. I should check this one too. And now after that, you're on the 15-minute chart of a market you don't even trade, and you can't explain how you got there. So you close the laptop at midnight, feeling like you worked. You didn't. You paid the attention tax for 4 hours and called it dedication. That 30-minute window that you feel is too little has a name. I call it your permission asset. It's the one trading edge that costs nothing to acquire and nothing to maintain. And it forces you to do what Livermore spent decades learning and what a jar of jam proved in a California grocery store. It removes the options that feel productive but produce interference. Over 3 years, I went from 71 trades in 3 months to 21 trades in a whole year. My account stopped bleeding, and one of the variables I changed was how long I sat at the screen. The trader who shows up for 30 focused minutes and walks away is structurally closer to the professional trader's routine than to the grinder's 4-hour trading session. The grinder thinks he's outworking you, but he's outpaying the attention tax. I show up, I execute, and I leave. Your constraint was the edge all along. You've got the effort flip point, and you've gotten the permission to walk away. But sit with that for a second. You have a window and no sequence. What do you analyze first? In what order? And what do you do when you scan every market and find nothing to trade? That's the gap this next video fills. It's called the part-time trading checklist that made me profitable. And it walks through the exact sequence that turns 30 minutes of staring into 30 minutes of execution. Without that sequence, the permission asset stays a nice idea. So see you in that video.